Are you an investor looking for an opportunity with oil stock investment? Maybe you're curious about why your fuel expenses fluctuate too much. Well, several factors affect the oil prices. If you want to learn what are the factors influencing the oil price, make sure to watch the video until the end. But before that, we've got some trivia for you. Do you know that the United States consumes almost 1/4 of the world's oil? Well, according to the Energy Information Administration, the United States consumed 20.30 million barrels of oil every single day on an average basis in 2022. This amount is a staggering 21% of the world's total oil consumption. Now, do you think that the presidents of the United States are the ones responsible for this? Not. Too fast. Let's jump to the main culprit. Well, it's not actually the president who controls the oil prices. The truth is, there's a very powerful organization hidden that controls the oil price. It's OPEC, the Organization of Petroleum Exporting Countries. As of 2021, OPEC is made up of 13 powerful countries that produce oils. These are Algeria, Angola, Congo, Equatorial Guinea, Gabon, Iran, Iraq, Kuwait, Libya, Nigeria, Saudi Arabia, the United Arab Emirates, and Venezuela. These nations collectively control 80% of the world's oil reserves. Here's the catch. OPEC plays a game of supply and demand, setting production levels to meet global needs. OPEC possesses the power to manipulate the flow of oil and gas, effectively controlling the dial that adjusts prices. Remember what happened in 2014? OPEC had pledged to maintain oil prices above $100 per barrel, but everything took a wild turn. Midway through the year, the price of black gold took a nosedive, plunging from over $100 to below $50 per barrel. It's an excellent news for the consumers, but what about the investors? Well, who's to blame? OPEC played a major hand in that oil roller coaster. They refused to cut oil production, flooding the market with a very high supply, causing the prices to drop significantly. Are you a consumer or investor during that time? Please tell us your thoughts on OPEC's power in the comment section below. Now, let's move on. Have you heard of the supply and demand in a market before? Supply and demand determine the price range of the product and services. It goes the same for the oil price. Are you wondering how? When the supply is higher than the demand, the price will be cheaper. But when the demand is higher than the supply, the price will be more expensive. Let's consider a scenario. Remember what happened in 2014 when the expected oil price of $100 became $50 instead? OPEC continued to produce more oil, which in turn increased the supply. Coincidentally, the demand for oil lowered in Europe and China. This is a perfect example of excess supply coupled with low demand that will lead to a huge drop in price. Let's have another scenario. Remember the recent news about Russia and Ukraine war that happened in 2022? The UN restricted their country members from having transactions with Russia. But as we know, Russia is the third largest oil producer worldwide. Thus, cutting them out led to a decrease in supply. And what happened is the price of oil skyrockets in just a few days. Scary, right? So what do you think about the volatility of oil prices with supply and demand? Another influencing factor is natural disasters. Have you watched the news before and seen great catastrophes like massive earthquakes, tsunamis, or tornadoes? We can't control the nature, but it has the power to change the oil prices in many ways. Do you remember Hurricane Katrina, which happened in the United States in 2005? Katrina devastated the Gulf Coast, damaging rigs and refineries responsible for almost a fifth of America's oil production. That was a serious hit to the economy. Then the effects were so immediate. With so much supply wiped out almost overnight, oil prices surged. The price of a single barrel jumped to massive $13 in response to the hurricane. It showed just how vulnerable our oil infrastructure could be to extreme weather. Another example is 6 years later, around 2011, when there was another kind of flooding, which also caused oil price turbulence. Record-breaking floods along the Mississippi River disrupted shipments of crude oil. Also, barges that normally transported millions of barrels downriver were largely halted by the rising waters. Again, the loss of transport and temporary reduction in supply was enough to move market prices. It serves as a potent reminder of how oil prices will act according to the forces of nature. Now let's move on to the next part. Do you know that the effect of interest rates not only applies to your credit card or loans? Interest rates also affect oil price, and their relationship is complex. Higher interest rates increase costs for consumers and businesses. When borrowing becomes more expensive, people may drive less and companies could scale back production. Therefore, less demand at the gas pump could then decrease pressure on oil prices. However, lower rates have the opposite effect. When everything is cheaper, consumers and industries are more willing to spend. More economic activity tends to mean burning through more barrels of oil. Therefore, increased consumption could drive prices upward. However, interest rates also influence oil prices through their impact on the US dollar. When rates rise, the greenback often strengthens compared to other currencies. Since oil is priced globally in dollars, American oil importers get more for their money when exchanging currency. Stronger demand for dollars overseas can help offset higher oil costs at home. And it works the other way too. A weaker dollar means each American note buys less oil on the international markets. As a massive oil consumer, this dynamic of currency exchange rates could make crude more expensive on the world stage. So while interest rate movements don't perfectly predict changes in oil value, there are rational economic explanations for why the two might evolve together or counter one another at different times. The relationship remains complicated, shaped as much by currency effects as direct supply and demand forces. Another area to consider is the production expenses. We all know that every business has its own type of major expenses. A business with high expenses means the price will go up too. The same goes for oil prices. The oil might be free in nature, but the cost of drilling and producing oils will be expensive. The cost of extracting oil varies greatly depending on its location and geological characteristics. Pumping crude oil from the oil sands of Canada is significantly more expensive than the shallow reservoirs of Saudi Arabia. When the cheap and easy reserves are greatly reduced, the high-cost supply could propel prices higher to keep pace with production. America's output also holds powerful sway over price fluctuations. With a bloated global supply in recent years, even small drops in U.S. production can tighten available reserves and tip the scales upwards. Such declines put a delicate system on edge. Nowhere is this tension more evident than in oil storage. Do you know that there's a factor that increases oil prices even when the demand is too low? With consumption crashing due to the pandemic, reserves rapidly swelled, threatening to max out critical storage hubs. Around 2020, Oklahoma's reserves bulged to 60 million barrels, squeezing its storage limits. That is why managing oil storage is a delicate balance. When there's too much stored crude, it can lower prices due to higher supply. However, limited reserves can risk causing shortages and higher prices at gas stations. Balancing supply, storage, and demand is critical to avoid this type of fluctuations. Navigating this trade-off between production, storage, supply, and demand will continue shaping oil's volatile marketplace for the foreseeable future. One wrong move could tip the scales with far-reaching economic consequences. In conclusion, predicting oil prices is complex due to the numerous influential factors. While supply and demand fundamentals drive fluctuations, major company, country, and organization oil producers strategically impact markets. Geopolitical events and natural disasters also introduce uncertainty. Production costs, storage volumes, and interest rates contribute further complexity to oil's active pricing environment. For consumers and investors alike, carefully navigating this interplay of diverse risks and opportunities remains key to making sense of oil's choppy waters. And that's a wrap. If you want to know more about investments, make sure to watch our other videos, including this one. Stay tuned for more investment videos. Thanks for watching. Have a great time oil investing.